Welcome back to Investing Talk Podcast. We're thrilled to have you join us for another deep dive. Today, we're peeling back the layers on Venus Concept, a name that's been, well, quite the roller coaster ride in the medical technology sector. You've asked us to unpack its recent performance, financial health, and future prospects. Our mission for you today is to cut through the noise, distill the essential insights, and hopefully arm you with a clearer understanding of what's truly happening with this company. Before we get into the details, if you find this valuable, please consider subscribing, liking, and maybe leaving a comment. Your engagement really helps us bring more of these analyses to you. And if you'd like to support us further, you can always consider buying us a coffee.
We definitely have a significant amount to cover today, particularly given the recent whirlwind of activity in the company's pretty complex financial journey. We'll be navigating everything from their product portfolio and market position to their latest revenue figures, the nuances of their debt, and some, well, very significant market events. It's a challenging picture, no doubt, but one that offers some crucial lessons, I think.
Absolutely. So let's begin by setting the stage. What exactly does Venus Concept do, and where do they aim to make their mark in this competitive medical technology landscape?
Okay, so Venus Concept is a global medical technology company. Their focus is squarely on the aesthetics and hair restoration markets. They develop and commercialize minimally invasive and non-invasive technologies. Think devices used for dermatological or surgical procedures like the Venus Legacy for body contouring or the Venus Versa, which is kind of a versatile aesthetic platform. Then there's Venus Viva for skin resurfacing. On the hair restoration side, they offer systems like NeoGraft and the RT's IX robotic hair restoration system. They've really cast a wide net, operating in over 60 countries.
Yeah.
And they target traditional markets like dermatology clinics and plastic surgery offices, but they're also expanding into, let's say, non-traditional avenues like family medicine practices and med spas.
Right, so it sounds like a pretty diverse portfolio within what seems to be a growing aesthetics market. But if we look at the company's recent stock performance, it certainly hasn't been a smooth ride. Roller coaster feels like an understatement, honestly. What does the stock's journey tell us, especially over the past year?
You're not wrong there. It's been incredibly volatile, almost breathtakingly so. Over the past year, the stock has plunged from a high of $14.50 all the way down to a low of $2.10.
1450 down to 210.
Yeah. To put that in perspective, if you were an investor who bought in at the high point, you would have seen, well, over an 85% loss on your investment within just a year. And in the last 6 months alone, it's seen that sharp decline from around $14 down to roughly $2, which, represents a massive destruction of shareholder value.
That's a staggering drop. Yet, I did notice something about a dramatic price surge back in April that briefly made headlines. What was that sudden spike all about? It almost seemed counterintuitive given the overall trend.
It was indeed a momentary climb on that roller coaster. In April, Venus Concept experienced an intraday surge of over 250%.
250%.
In one day.
In one day, yeah. This was primarily driven by positive news surrounding a debt restructuring. Specifically, they managed to convert $11 million of debt into preferred stock. This move was, initially perceived as a significant positive, as it reduced immediate financial pressure by turning a liability into equity. Gave them some breathing room.
Okay, that makes sense initially.
But that gain was not sustained. The stock retraced most of those gains within weeks. As of late June, the price hovered around $2.18, which is notably below even some of its recent offering prices from earlier in the quarter. Those were closer to the $3-4 range. So that tells you a lot about the market's long-term skepticism, despite that short-term relief. That quick reversal really underscores the volatility, doesn't it?
Yeah.
Now, we've seen the dramatic stock swings, but to understand why those happened and what's truly driving this company's valuation, we need to peel back the layers and look at the hard numbers. Let's talk financials. What do the latest revenue figures and earnings tell us about their operational health? Is the business itself struggling?
Right, and if we connect this to the bigger picture, the financial health of Venus Concept paints a clearer, albeit challenging picture. Their latest available revenue data, looking at the trailing 12 months as of June 2025, shows $61 million.
That's $61 million, okay.
And this is down from $76 million year over year.
Wow, okay.
And looking specifically at the first quarter of 2025, revenue is $13.6 million. That's down almost 22% from the first quarter of 2024. So this isn't just a recent dip. It indicates a persistent revenue contraction over the past 3 years. This trend suggests either significant business headwinds, like maybe shrinking market demand for their products, or perhaps a struggle with their sales strategy, maybe losing market share.
So declining revenue and a persistent decline at that. That raises the critical quotient of profitability. Are they actually making money from their operations?
Well, the short answer is no. The company is deeply unprofitable. For the trailing 12 months, Venus Concept reported a net loss of $49.57 million.
Almost 50 million in losses.
Exactly. And that loss has actually widened from the previous year. Their Q1 2025 net loss also widened to $12.4 million, compared to about a $9.8 million loss in Q1 2024. What's particularly alarming is their earnings per share, or EPS. It stands at a negative $71.58 per share.
Negative $71 per share.
Per share. And their adjusted EBITDA loss also increased to $8.3 million from $5.1 million in the prior year's quarter. This indicates their core operations are consistently burning cash.
A negative EPS of $71.58, coupled with that tiny, $4 million market cap, that's truly startling. What does that number, especially in combination with their market cap and debt, really mean for current or potential shareholders? That sounds like a massive red flag.
It absolutely is. And that's where it gets critical for anyone considering this company. A negative EPS of $71.58 when the market capitalization is a mere $4 million. Well, it implies an incredibly small number of outstanding shares, which means every time they raise capital, even relatively small amounts like that recent $1.15 million offering, it translates into a massive percentage of new shares being issued.
So huge dilution.
Huge dilution. It's like adding a huge amount of water to an already very diluted drink for existing shareholders. This is, pretty much the definition of severe financial distress and signifies an almost guaranteed potential for significant shareholder dilution going forward.
Okay, and what about the debt situation? You mentioned the swap, but what's the overall picture?
Right. Regarding their debt, as of March 31st, 2025, their total debt was approximately $35.5 million. Now, while that $11 million debt-to-equity conversion in April was a positive step, technically, to reduce immediate leverage, it only tackled a fraction of their overall debt burden. It hasn't been nearly enough to offset the ongoing losses or address their negative cash flow concerns. For example, in fiscal year 2024, they used $11.1 million in cash just from operations.
So they burned through $11 million.
Just running the business, yeah.
Yeah.
So while the debt swap provided some balance sheet flexibility, it's definitely not a silver bullet, and their return on equity remains deeply negative because of these persistent net losses.
Okay, so the company's bleeding cash, revenue is shrinking, and the EPS numbers are, well, quite shocking. It really makes you wonder if there's any silver lining at all. What stands out to you as the absolute clearest red flags in these financials? And is there any glimmer of hope?
Well, this raises the important question, right? What are the key indicators? And you've really hit on the core issues. The most prominent red flags are indeed those persistent, large net losses with no clear path to profitability in sight. This isn't just a bad quarter, it's a multi-year trend. Second, that ongoing revenue contraction indicates significant business headwinds or shrinking demand, meaning their core business is effectively getting smaller. And third, that extremely high EPS loss, as we discussed, suggests severe financial distress and a high likelihood of continuous heavy dilution for existing shareholders. It just keeps happening.
Right. Any strengths at all? Anything positive to grasp onto?
Well, the main strength that's often noted is that debt-to-equity swap we talked about. Converting $11 million of debt to preferred stock did provide a temporary reduction in immediate financial pressure. And it could potentially improve future solvency metrics.
Big if there.
Big if, exactly. If operational performance can stabilize. It was a strategic move aimed at easing some pressure on their balance sheet, perhaps buying them more time. And the fact that creditors were willing to accept preferred stock, well, it signals maybe some conditional belief in recovery or perhaps just an acknowledgement that getting repaid traditionally might be tough. But really, it's more of a survival tactic than a genuine growth driver.
So a tactical move to stay afloat rather than a fundamental shift in trajectory. Okay. Given all these financial challenges, what does the broader market currently think about Venus Concept? Is there much analyst coverage or is it mostly just a retail chatter?
Market sentiment has certainly been mixed and more recently quite cautious. While there was that brief surge of optimism in April following the debt conversion news, that faded really quickly as the underlying financial issues just sort of reasserted themselves. Currently, there are no major analyst ratings available for Venus Concept.
None at all.
None readily available from major firms, and that's a significant indicator in itself, suggesting a distinct lack of institutional interest. Larger funds, institutional investors, they typically steer clear of companies with such deep financial struggles and that kind of high dilution risk. Social media chatter did spike dramatically during the debt swap event, but it has since quieted down significantly. Sentiment among retail investors seems to have turned very cautious due to the ongoing financial struggles. You see investor discussions reflecting widespread skepticism, particularly around those repeated dilutive financings and the company's persistent cash burn rates.
That paints a pretty stark picture of how the market perceives them. Not much confidence there. So how does Venus Concept truly compare to its peers in the medical aesthetic space? Are they holding their own, or are they significantly lagging behind?
Well, what's interesting here is how Venus Concept stacks up against its competitors. Companies like, say, Cutera or Cynosure, for instance, are significantly larger. They have greater market share, more robust R&D budgets, more expansive distribution networks. Venus Concept, with its, $4 million market cap, is much, much smaller. It operates on a completely different scale. It consistently faces greater revenue declines and deeper losses than most of its competitors. This positions it more as a challenger and currently a clear laggard in the market.
So falling behind.
Pretty much. While they do continue to innovate with their proprietary medical aesthetic devices, and that is a legitimate strength in terms of product development, this innovative capacity is currently just overshadowed by weak execution on the sales front and profound financial instability. It's really difficult to compete effectively when you're constantly fighting for survival, you know?
Yeah, that makes sense. It sounds like a challenging competitive environment, compounded by their own internal issues. What about the broader industry trends impacting them? Are there specific growth drivers that could, lift all boats? Or are there significant risks facing the entire sector right now?
The industry itself does have inherent growth drivers, certainly, like the global and increasing demand for non-invasive aesthetic procedures. There's a clear trend towards less invasive treatments, which Venus Concept's portfolio does align with.
Okay, so that's a positive backdrop.
It is. However, there are also significant risks that affect the entire sector. These include regulatory hurdles for new devices, economic slowdowns impacting discretionary spending on elective procedures.
Because these aren't essential treatments for most people.
Exactly. Aesthetic treatments are often considered non-essential, and there's the constant need for technological innovation just to stay competitive. The medical aesthetics sector, in general, seems to be facing some headwinds currently, with demand softness persisting post-pandemic and industry-wide pricing pressures being a common theme. So Venus Concept is operating in a tough environment, but their struggles appear to be amplified by their own internal challenges.
Right. Looking forward then, we've discussed the significant risks quite a bit. But are there any potential catalysts, anything on the horizon that could realistically turn things around for Venus Concept? Or are those risks just too overwhelming for any single event to counter?
Well, there are a couple of potential catalysts that bear watching, definitely. On June 6th, Venus Concept announced a sale agreement for its hair business for $20 million.
$20 million. Okay, that sounds significant given their market cap.
It is significant cash, yes. This is expected to provide much-needed liquidity. But remember that cash burn, $11.1 million from operations in fiscal 2024. That $20 million from the sale provides, less than 2 years of operational runway at current rates, assuming things don't get worse.
So it buys time, but doesn't fundamentally change the burn rate yet.
Precisely. It's a cash infusion, but it emphasizes the urgency for a fundamental operational turnaround. This sale also allows the company to focus its resources on its core aesthetic device lines, which could lead to better efficiency. We'll see. The next earnings report, scheduled for August, will be critical. It could clarify their post-divestiture strategy and provide an updated picture of their financial performance after this asset sale.
So a significant cash injection that buys them time, but doesn't solve the underlying cash burn problem on its own. What are the major risks they still face then, especially after multiple capital raises that have already caused so much dilution? What should people be most worried about?
The risks remain substantial, and they're definitely interconnected. First, the ongoing operating losses. They severely threaten their long-term viability if turnaround efforts fail to materialize into profitability very, very soon. Second, there's still significant potential for further dilution. We just keep seeing it. Given their repeated equity offerings within such a short period, like in June, they announced another offering of 434,720 shares at 2.65 cents, aiming for just $1.15 million gross proceeds.
Small amounts, but big dilution relative to the share count.
Exactly. And they had similar offerings in April, totaling almost $2.7 million. These moves signal continuous, urgent capital needs. This pattern of capital raises is a massive red flag in itself. Other risks include persistent liquidity constraints, macroeconomic uncertainty impacting consumer discretionary spending, and importantly, significant execution risk around their divestiture and the subsequent reinvestment plans. Selling a business unit doesn't guarantee success. They really need to prove they can operate profitably with a narrower focus now.
This has been an incredibly thorough and, at times, pretty sobering look at Venus Concept. So what's the ultimate takeaway here for anyone considering this company, whether maybe as a speculative bet or, heaven forbid, a long-term investment?
Yeah, considering everything we've discussed, the persistent heavy losses, the declining revenues, that extreme share price volatility, the clear lack of institutional interest, and the continuous need for these dilutive capital raises, I think, the risks far outweigh any potential rewards at this stage. Despite strategic moves like the asset sales or the debt swaps, the company's fundamentals remain highly challenged. Unless there is clear, undeniable evidence of sustainable profitability ahead, or maybe new, significant growth drivers emerge post-divestiture that fundamentally change their revenue and cost structure, well, it appears best to avoid this stock. This would be reserved perhaps only for the most highly speculative traders, those seeking short-term volatility rather than any kind of long-term value. Based on the current financial picture, the recommendation is, unfortunately, a clear sell.
That's a very clear assessment of Venus Concept, and it really highlights just how critical it is to look beyond those headline-grabbing surges and really dig into the underlying financials and market position. The short-term bursts of optimism are just that short-term, it seems.
Indeed. It's a powerful reminder, I think, that even in a growing industry like medical aesthetics, individual company performance can vary wildly. And strategic moves like asset sales, while they provide temporary relief and buy time, they don't automatically resolve deep-seated financial issues. They merely create an opportunity for a turnaround that still needs to be executed flawlessly. And that's the hard part.
So for you, our listener, perhaps the question to consider is, how much weight do you place on long-term financial health and a clear path to profitability versus short-term speculative movements and the maybe faint hope for a turnaround that may never materialize when you're evaluating investment opportunities? Thank you for joining us on this deep dive into Venus Concept. We hope this analysis provides you with some valuable insights. Until next time, keep learning, keep questioning, and keep making informed decisions.